Welcome to the Fear and Greed Business Interview. I'm Adam Lang. Last week, the Reserve Bank Board removed its bias towards increasing interest rates. Then we had a shock low unemployment number, suggesting that, yes, rates will come down, but maybe not as soon as everyone thought. So yesterday's release of monthly inflation data is a very important piece of the puzzle, though I don't know if it's made the Reserve Bank job any easier. Mousina is AMP's Deputy Chief Economist. Deanna, welcome back to Fear and Greed.
Thank you, Adam. Nice to chat.
Headline CPI came in at an annual rate of 3.4% in February. Was this better than you expected?
It was, and I was pleasantly surprised. When we did our bottom-up forecast, ours was showing something more of 3.7%. Usually you get a big increase in education prices in February, and also fuel went up over the month as well. So that contributed to our higher forecasts. What I thought was interesting about February is that the ABS surveys, obviously, every single month in the quarter. But as we know, the monthly CPI data is not completely as fulsome as the quarterly data because not everything is surveyed every month. But in the month of February, which is the second month of that quarter, you actually get the most number of categories surveyed. And in particular, there are a lot of services that are surveyed, and services has been one of the key areas that's been of concern for the Reserve Bank. Of course, they're worried that services inflation is going to remain sticky. So the downside surprise was pleasant, both from the point of view that inflation is obviously still trending lower and below the RBA's forecast, but also from the point of view that services inflation is continuing to slow as well.
Have you been surprised by how goods inflation has changed?
Well, we have a lot of forward-looking indicators of goods inflation that we use for our global inflation forecast. So we look at global commodity prices, semiconductor prices, shipping costs, container costs, the Baltic Dry Index, Chinese Producer Price Index. And we've been seeing this pattern in the past few months where goods prices haven't really been slowing much further. They've kind of bottomed, and they've obviously slowed from their highs in 2021 and 2022, but they're not really coming down too much further. And I think that the pace of growth in goods inflation is still relatively in line with inflation targets, but only if you get services declining as well.
Okay, so if you can look forward, and I guess what you're seeing in that data and what you anticipate might happen across goods inflation and services inflation, what should we be looking out for?
Well, from a services point of view for Australia, there are a few things that are key. So one is what happens to rents. Rents have the highest share of services inflation from the services basket point of view. I think in the near term, rents are still going to remain quite high. We still have a lot of permanent migration and long-term migration into Australia, despite the fact that the government has been saying that they're tightening on visa conditions and restrictions. Early numbers from this year still say that immigration's running at about 550,000 people over the year. So in the short term, rents are still probably going to remain quite elevated. The good news, though, is that we're seeing quite significant weakening in prices for accommodation and travel and holidays. And that was one of the biggest services area that increased inflation for services price in the past 2 years, and one that the Reserve Bank's been talking about. That's good news. And also I'm watching wages growth. Wages growth is really the key component of what happens to services prices. When you think about what really drives services inflation, a lot of it comes down to the cost of labor. So we do need to see the pace of wages growth slow. It probably needs to be somewhere at 3 to 3.5% on an annual basis for the Reserve Bank to be comfortable that inflation's going to be within its target band.
Stay with me, Deanna. We'll be back in a minute. I'm speaking to AMP Deputy Chief Economist Deanna Mousina. If we turn our attention to unemployment, how much has last week's unemployment number thrown a spanner in the works?
Well, if you believe it, I mean, I'm not sure that I do really. I think that the seasonal factors going on at the ABS, I don't know what's going on with the seasonal factors, and also with the questions around how the ABS is asking questions about people that are unemployed. I just find it hard to believe that if people have a job to go to, that they would be technically classified as being unemployed. I'm not really sure I understand what's actually going on behind some of these questions that are being asked. So I don't really know where the unemployment rate is at the moment. When I look at all the forward-looking indicators of employment growth, they're all showing much weaker employment conditions to me than the official ABS data is. So I kind of have to look at both of those things. I think that the labour market is still clearly holding up better than expected, but I do think we will start to see some of that weakening come through, and maybe that one-off decline in the unemployment rate will be reversed in the coming months.
So speaking of those employment numbers, the Seek job ads numbers that came out showing a reduction in the number of job ads, how are you seeing that?
Well, Seek is not the only provider that gives indications of job vacancies and job ads. There are a whole raft of them, and they're all pointing to a weakening in job openings, job vacancies, and hiring intentions that businesses have. And Seek even have an index about the number of job applicants per job, and the number of job applicants per job has gone down, which normally tends to indicate some rise in the unemployment rate. So those are the types of forward-looking indicators that I look at when I'm thinking about the prospect for employment growth in the next few months.
And when you consider all of this data and even some of the things that perhaps we haven't spoken about today, what are you feeling and what does this mean for interest rates?
Well, our base case has been that we would see the start of a rate cutting cycle in June. And while I think that we are going to be right on our view about inflation, so that inflation's coming down in line with our medium-term forecasts, slower than the RBA's expectations. So I think the inflation environment will provide the Reserve Bank room to cut interest rates if they want to, or feel the need to. But I'm not convinced that the growth outlook is going to slow enough by June to warrant a rate cut. And what we really need to see for a rate cut to occur is a weakening in the labour market, I think. If the unemployment rate stays 3.7 or 3.8% like it did in the February data, I think that that's probably too low for the Reserve Bank to consider cutting interest rates, even if inflation warrants them to do so. So our base case is still for a June start to rate cuts, but I have to say that the risk of that is probably around August or September, which is more in line with market pricing at the moment.
That is great perspective. Retail sales are due out today, and what are you expecting to see?
I think we will get a strong bounce in retail spending. The banks publish their credit card data on a monthly basis, and that actually increased quite a lot for the month of February. I think that Taylor Swift probably did have some impact on that, although I was interested to see that in the monthly CPI data, the ABS actually mentioned that despite the fact that hotel prices went up in Sydney and Melbourne over February due to Taylor Swift, there were offsets from other capital cities. So maybe the impact won't be as strong as we're expecting, but the bank credit card data was certainly strong for February. But even if we get a bounce over the month of Feb, I think we need to still look at things on a 3-month basis because we've had a lot of seasonal factors going on with the retail spending data. And that should still show that monthly retail sales is averaging at 0.2 or 0.3% over the month. That's not really that high. And in annual terms, retail volumes are still negative, and per person retail spending is negative as well. So I still say that the retail sector is in a pretty weak spot, and consumers have cut right back on retail consumption, focusing more on that essential spending.
That is terrific. Deanna, thank you so much for talking to Fear and Greed.
Thanks so much.
That was Deanna Mousina, Deputy Chief Economist at AMP. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Adam Lang. Enjoy your day.